Welcome back to the Deep Dive. Today we are taking on a topic that really it sits right at the center of every meaningful long-term financial structure, retirement investment products.
It's a huge one.
It is. And this isn't just about, accumulating a pile of money. It's about successfully navigating two entirely different phases of your life.
Two completely different mindsets, really.
Exactly.
Yeah.
You've got the explosive growth phase where you want maximum compounding, you want to take smart risks. And then you have the critical sustainable income phase where stability is, well, it's everything.
Mm-hmm.
Okay, so let's unpack this. The source material you shared with us is, I have to say, a pretty comprehensive roadmap. It really cuts through the jargon.
It tries to, yeah. It covers a lot of ground.
It does. It details everything from those mandatory government schemes that form the untouchable base of your portfolio, all the way to some sophisticated late-stage income tools like reverse mortgages.
Which a lot of people are still a bit wary of.
They are, absolutely. So our goal today is to really look at the structure of these products, the specific government guarantees they might carry, and, crucially, the tax treatment that defines how efficient they actually are.
That's absolutely right. Our mission today is to give you a clear framework for these two distinct financial goals. The first one is all about building the corpus efficiently. That's the accumulation phase.
All about growth.
All about growth. It's about leveraging time, maximizing that compounding effect, and intelligently managing risk exposures like market volatility. But then the second goal is the distribution phase.
The drawdown.
The drawdown, safely drawing down that large corpus over decades while protecting your purchasing power against that silent killer, which is always inflation.
Right.
So we'll look really closely at how specific schemes are structured to fulfill these fundamentally different roles. If you're trying to gain an edge in understanding your long-term wealth strategy, particularly how to optimize contributions and withdrawals, this deep dive is, well, I think it's packed with critical nuggets of insight.
Let's start right at the foundation then, the non-negotiables. The things that form the base layer of savings for millions of employees. We're talking about forced savings, really, starting with the Employee Provident Fund, or EPF. In many economies, particularly those focused on a broad Social Security net, this isn't an option, is it? It's mandated by law.
Precisely. This whole structure, which is designed to ensure a baseline level of retirement security, is built on this core piece of legislation, the Employees Provident Fund and Miscellaneous Provisions Act, and it's from 1952.
Wow, so it's been around a long time.
A very long time. And that longevity just speaks to the importance of the scheme. It's the legal engine that requires all covered employers to offer these specific structured savings mechanisms to their workers. It's not a perk, it's a requirement.
And the real power of the EPF mechanism is just how early and consistently it forces you to save. So according to the sources, what does that mandatory contribution structure actually look like?
The standard mandatory structure is designed as this really powerful 24% combined injection into your savings.
24%.
Yeah. Both the employer and the employee must contribute 12% each of the basic emoluments and, relevant allowances. Now, there are some special cases where that rate can drop to 10%, but 12 is the standard.
So right from your very first paycheck, almost a quarter of your basic pay is being siphoned off into this long-term vehicle.
Exactly. That combined contribution is designed to just harness the power of compounding over a 30 or 40-year career. It is the absolute definition of a disciplined, long-term savings anchor.
Okay, so that 12% from the employee is the floor. That's the starting point. But many diligent savers, they see the guaranteed interest, the tax treatment, and they realize, hey, I can accelerate this. They use the Voluntary Provident Fund, or VPF.
Right.
So an employee can contribute over that statutory rate. They could even, in theory, contribute up to their entire basic salary if they really wanted to.
This VPF option is, it's a fantastic vehicle for disciplined savers who are just purely focused on maximizing their corpus. However, and this is a big however,
There's always a catch.
there's always a detail you need to know. Here's where the planning gets complicated, and it's where a lot of people misunderstand the mechanics, especially when they compare it to schemes like the NPS or a typical 401k match in other countries.
Okay.
The crucial detail here is that while you, the employee, can contribute extra under VPF, the employer's contribution remains fixed at that statutory rate, that 12 or 10%.
Ah, so they don't match your extra contribution.
They do not. The employer is not obligated and generally does not match any additional VPF contribution you make.
That distinction really changes the motivation, doesn't it? I mean, if the employer matched, VPF would be an unbelievable arbitrage play on guaranteed return.
It would be a no-brainer. Free money.
Right. But since they don't, VPF just becomes a very disciplined, high-return savings vehicle that's funded purely by you, the employee. It's not a bonus from your employer.
Exactly. It forces you to look at VPF purely on its own merits and stack it up against other available investments you could make with your post-tax salary.
Which brings us to the tax treatment. Because historically, this was the golden ticket.
It was. Historically, the EPF was considered the absolute gold standard of EE that's exempt savings.
Let's break that down.
Sure. So your contributions were deductible from your income. That's the first E. The interest you earned on the corpus was completely tax-free, the second E. And then the accumulated funds you received at retirement were generally exempt from tax under the old tax regime. That's the third he. It was a perfect tax shelter.
But, as often happens, the government saw a significant cohort of, let's say, ultra-high earners who were leveraging this EE status to the max.
They were. They were essentially using the EPF to shelter massive contributions, far beyond what the scheme was originally intended for, and turning it into a primary wealth management tool.
Which led to a very important and I'd say game-changing rule modification that took effect on April 1st, 2021. This is where it gets really interesting for anyone who's optimizing their wealth. What is the specific tax threshold that every learner now needs to be aware of?
Okay, so this change fundamentally altered the tax efficiency for those high-value contributors. The interest that's credited on the employee's own contribution, so just your part, now becomes taxable if that contribution exceeds 2,50,000 rupees in a single financial year.
2.5 lakhs.
2.5 lakhs. That threshold basically drops the curtain on that tax-free status for the interest on any excess contribution. Now, there is a small carve-out.
Okay.
If you're an employee working for an employer that, for some specialized reason, does not contribute to the fund, then that limit is doubled to 5 lakh rupees. But for most people, the number to remember is 2.5 lakh.
So that threshold acts like a critical signpost, especially for people who are aggressively using VPF. If you save up to that amount, you enjoy the tax-free interest, you maintain that coveted EE status.
Correct.
But the moment you go over it, suddenly the interest generated by that excess contribution is added to your income and it's taxed at your marginal rate.
Yep.
This effectively means the government now views the EPF contribution as capped from a tax-free perspective. Any excess is treated more like a regular debt instrument where you pay tax on the interest.
It changes the optimization calculus entirely. It just does. If you're a high earner, once you hit that 2.5 lakh mark with your own contribution, you have to stop and ask a serious question.
Which is?
Is the guaranteed return of the EPF, even if the interest on the extra bit is now taxable, still a better deal than your next best alternative? You know, is it better than the MPS or a diversified equity mutual fund or something else?
Right. It forces a real financial planning analysis where previously the answer was just always more EPF is better.
The simple answer is gone. Now you have to think.
Exactly. Now, let's just briefly touch upon the other half of that mandatory structure, the Employee Pension Scheme, or EPS. This is the government's safety net, and it's focused not on that big lump sum accumulation, but on guaranteed distribution.
That's right. The EPS is run by the EPFO, the same body, and it's a critical piece of the puzzle because it is guaranteed by a government. Its primary purpose is to provide a defined benefit.
Meaning a predictable payout.
A predictable payout. Specifically, a pension for life to members or their family upon retirement at age 58. It's funded by rerouting a portion of the employer's mandatory 12% contribution. So a part of what your employer puts in goes to this pension scheme.
So it's a good way to think about it. The EPF is the big lump sum corpus you build, and the EPS is the small but guaranteed monthly paycheck you get for life.
That's the perfect way to look at it. One is your nest egg, the other is your lifelong income stream.
Okay, let's move from the statutory mandate to schemes that are often offered by companies as a benefit, a way to attract and retain talent. Superannuation funds. You often see these in larger organizations. How do companies typically structure these schemes? Do they manage the money in-house or do they outsource it?
Companies primarily use two main structural methods for offering these group superannuation schemes. The first is to constitute a dedicated internal trust fund.
Okay, so they do it themselves.
Essentially, yes. In this case, they appoint independent trustees, and those trustees then hire professional fund managers to oversee and grow the corpus. This gives the company a really high degree of customization and control over the investment strategy.
And the second method?
The second, and often simpler route, especially for smaller organizations that don't want that administrative headache, is to invest through a standardized superannuation scheme from a life insurance company. The insurer just handles everything: the fund management, the administration, and the eventual guaranteed payouts.
Got it. So when the employee finally reaches retirement, they typically don't just get handed the entire corpus in cash. It's designed to provide income, but they are often given the option to take some of that money out immediately. That process is called commutation. Can you define that for us?
Commutation is simply the facility that allows a retiring employee to take a portion of their total annuity corpus as a lump sum right at retirement. Our sources specify that this portion is typically limited to up to 1/3 of the annuity corpus.
Only a third.
Only a third. The remainder, the other 2/3, must, by rule, be used to buy an annuity, which is what provides that periodic, regular income for the rest of their life.
So you're basically trading long-term income security for some immediate liquidity. If I had, say, a 3 crore corpus built up in my superannuation fund and I choose to commute,
Then you could immediately access 1 crore in cash.
and the other 2 crore gets locked into an annuity.
Precisely. It's a classic liquidity versus longevity decision. You get a big cash infusion now, maybe you want to pay off a mortgage or buy a property, but your guaranteed monthly income for the next 30 years will be calculated on a corpus that is now 1 crore smaller. A smaller principal means a smaller pension.
This leads us to another really critical tax ceiling, where the government is looking at the total generosity of the employer across multiple schemes. This is a vital integration point where employer contributions across MPS, PF, and superannuation are all grouped together to determine what qualifies as a taxable perquisite.
This is a complex area, but it's absolutely vital for high-income earners to understand. The tax net focuses on the combined generosity across those three vehicles you mentioned.
MPS, EPF, and superannuation.
Right. So the combined employer contributions to all three of those funds that exceed 7,50,000 rupees in a single financial year.
7.5 lakhs.
7.5 lakhs. That excess amount, plus the earnings generated on that excess contribution, are now treated and taxed as a perquisite. They're added to your salary.
Wow. That is a staggering integration of rules. It means that if your employer is maximizing their contributions for you across all three schemes, which they often do for top executives, that cumulative benefit above the $750,000 mark is essentially just added back to your taxable income and taxed at your highest marginal rate.
It is the government's way of ensuring that these specific defined benefit mechanisms don't become massive tax shelters for remuneration above a certain level. So if you're a learner trying to structure your compensation package, knowing that our 7.5 lakh ceiling across all three schemes is absolutely key.
It really is.
Because if your combined contributions are going to exceed that, you need to be very intentional about where those funds are coming from and how they're structured, because the tax efficiency just drops off a cliff beyond that point.
Right. Let's pivot completely. We've established the non-negotiable mandatory floor of your retirement savings, the discipline that's forced upon you by law. Now we can move into the realm of voluntary choice and more aggressive growth.
The fun part.
The accumulation stage. Here, the focus is pure, unadulterated compounding efficiency and, of course, protection for the corpus. We should start with the bedrock of safety. Debt instruments that are backed by the ultimate guarantee.
When security is absolutely paramount and you're looking for long-term compounding with minimal hassle, the government-backed debt instruments are your best friends. The Public Provident Fund, or PPF, is the classic example here.
Right.
It is considered low risk because it's a debt-oriented investment where both the interest and the principal are guaranteed by the government. That is an ironclad guarantee. It just completely removes any concern about default risk.
That level of certainty is incredibly attractive, especially for small savers. But the PPF isn't universally accessible, is it? There's some very specific restrictions that limit who can participate.
Yes, and these are crucial limitations for our listeners to know. HUFs, that's Hindu Undivided Families, and NRIs, non-resident Indians, cannot open a PPF account.
Okay, that's a big one for NRIs.
It is, and furthermore, you are generally limited to opening only one account per individual. This really highlights its specific design as a long-term savings vehicle aimed squarely at the resident Indian population to help them build their personal retirement wealth in a very tax-efficient manner.
Okay, let's move to other instruments that are engineered specifically to lock up your capital and maximize that compounding effect by eliminating any periodic payouts. We're grouping National Savings Certificates, NSC, and Kisan Vikas Patra, KVP, here. What makes their mechanism so powerful for accumulation?
These instruments are just models of forced discipline and superior accumulation strategy. Their shared mechanism is that the interest compounds annually, it accumulates, and it is paid only on maturity.
Nothing comes out until the end.
Nothing. Think about that. There is no periodic interest payout hitting your bank account every quarter, which would just leak cash out of the compounding engine. The full interest is immediately plowed back in to earn more interest.
Yeah, and the lock-in helps.
It does. Their limited liquidity further supports corpus building by structurally discouraging the temptation for you to make premature withdrawals. They effectively turn passive saving into aggressive compounding.
And then we have government securities, or GSECs. They are the absolute benchmark for safety. But if they are so safe, why is the interest rate on a GSEC typically lower than, say, a highly rated corporate bond? This often confuses the learner.
It boils down entirely to one thing: credit risk. GSECs offer a lower interest rate simply because there is no credit risk or risk of default.
Yeah.
None.
Zero.
Zero. They are issued by the RBI on behalf of the sovereign government. The market will always compensate for higher risk in corporate bonds with higher coupon rates. GSECs are the safest possible asset, so they command the lowest rates. The trade-off is often safety from default versus the safety of your purchasing power. Because while GSECs are safe, their low yield sometimes means you lose the race against inflation.
Speaking of credit risk, let's look at the corporate debt market. How does the market quantify that perceived risk through the coupon rate they offer?
It's a very transparent inverse relationship, and it's tied directly to the issuer's credit rating. So corporate bonds with the highest credit rating, like a AAA, pay a lower rate of interest than those with lower ratings.
Because they're safer.
Because they are seen as much safer, with a much lower probability of default. If you're willing to step down that risk ladder, maybe from a AAA to an AA or even an A-rated bond, the coupon rate you're offered rises to compensate you for taking on that incremental default risk. The investor is constantly balancing their own risk tolerance with their yield objectives.
But safety from default is one thing. How do we manage the risk that just silently eats away at the purchasing power of our accumulated debt corpus? And that, of course, is inflation. How do inflation index bonds, or IIBs, solve this specific problem?
IIBs are a very clever tool. They are specifically designed to be an anti-inflationary weapon for debt investors. They work by ensuring that both the coupon income and the principal amount are adjusted for inflation based on a predefined index like the CPI.
So your capital grows with inflation.
Exactly. This adjustment protects the real value of your investment, ensuring your returns actually keep pace with rising prices. They are a very smart play for investors who are extremely bearish on the future of inflation, but still need the stability of a debt instrument.
And while we're on the topic of specific debt mechanisms, let's mention a unique product that offered an incredible tax advantage to debt holders back when they were prevalent. Which specific type of bond offered tax-free interest income?
Those are the tax-free bonds. They were historically issued by various public sector units, especially those focused on things like infrastructure development.
And the name says it all.
It does. The massive draw was that the interest income you received was entirely exempt from tax. So for individuals in the highest tax brackets, receiving a guaranteed and tax-free interest income was extremely attractive. They were willing to accept a slightly lower coupon rate than a comparable taxable bond because the post-tax return was so much better.
Okay, now to the most accessible and, I'd say, ubiquitous products. Bank fixed deposits, or FDs. They are the default choice for safety and convenience for millions. Why exactly are they deemed so safe, beyond just the bank's brand name?
The safety really comes from the regulatory structure that's in place to protect the small saver. Every single depositor is protected by the Deposit Insurance and Credit Guarantee Corporation, or DICGC.
The DICGC.
Right. And what that means is that each depositor is insured up to 5 lakh rupees across all the accounts they hold in a single scheduled bank.
So if the bank fails, you get up to 5 lakhs back.
Correct. Now, it doesn't cover the entire corpus for high net worth individuals, obviously, but it provides a crucial government-mandated safety net for the vast majority of savers against the risk of a bank failure.
And specifically for the accumulation phase, what feature of an FD should a learner absolutely utilize if their goal is maximum compounding over, say, a 5-year period?
You must choose the cumulative option for interest. This is so key for accumulation.
Not the payout option.
Definitely not the payout option. Instead of selecting the periodic payout, where the interest gets credited to your savings account quarterly or annually, you choose cumulative. That way, the interest is compounded back into the principal. This ensures the full principal plus all the accrued interest is working for you until maturity, which maximizes the compounding trajectory.
Simple but powerful. Now, moving to the post office time deposits, or POTDs. These also offer safety but have their own unique parameters, particularly regarding how their interest rates are determined.
Yes, the interest rate on a POTD is not fixed for the full tenure based on the date you invest. Rather, the underlying rate is reset each year by the government.
Wait, so my rate can change?
Not for your existing deposit. If you invest in a 5-year POTD, your initial rate is locked in for those 5 years. But the government reviews the macro interest rates annually, which then influences the rates offered for future investments. So the rate you get today might be very different from the one offered next year.
Got it. And there's a specific tax caveat regarding the POTD that often catches people out, particularly if they're comparing it directly to something like the PPF.
Absolutely. This is a common mistake. While the 5-year post office deposit does qualify for a tax benefit under Section 80C, under the old tax regime.
So you get a deduction on the initial investment.
You do. But the major caveat, the fine print, is that the interest earned on that deposit is still taxable. It's added to your income and taxed at your marginal rate. This makes it far, far less tax efficient than EE products like the PPF, where the interest is also tax-free.
Right. We can't talk accumulation without discussing the real engine of growth. Equity. It brings volatility, which definitely scares retirees. But for someone in the accumulation phase, that volatility can actually be used to their massive advantage.
Volatility is the young saver's best friend. It really is, provided they have a time horizon that's long enough to absorb the swings in the market.
So how do you leverage it?
The smart strategy here is leveraging regular fixed investments, what we call systematic investment plans, or SIPs. By accumulating equity in these smaller regular installments, you are effectively able to average out the cost of acquisition over market cycles.
Rupee cost averaging.
Exactly. When the market drops 20%, your fixed installment of, say, 10,000 rupees simply buys more units of the mutual fund, which lowers your average cost per unit. This is an incredible mechanism that smooths out that high-growth trajectory and tends to maximize returns over a 20 or 30-year period.
So accumulation is about automatically buying the dip, which turns volatility from a bug into a feature. Now let's talk about the eventual exit. When you sell those units after many, many years, long-term capital gains, or LTCG, from equity investments are currently taxed at a specific preferential rate once they exceed an annual limit.
That's right. Our sources confirm that LTCG from equity investments in excess of 1,25,000 rupees in a single financial year are currently taxed at 12.5%. Understanding this annual exemption is crucial, both for managing any portfolio churn and for determining your tax liability when you start drawing down the corpus during distribution decades later.
Okay, let's move to gold. It doesn't compound in the traditional sense, but every sophisticated financial plan insists on having a slice of gold in the portfolio. Why is that?
Gold serves two crucial roles in a portfolio. First, it provides portfolio diversification. It typically has a very low or even a negative correlation with traditional asset classes like equity and debt. When stocks are down, gold is often up.
And the second role?
Second, it acts as a safe haven. When geopolitical crises flare up or when equity markets experience sharp corrections, investors traditionally flee to the perceived safety of gold. This helps stabilize your overall portfolio returns when other assets are underperforming. It's like the parachute you pull when the equity plane starts dropping.
And the beauty today is we no longer need to worry about the historic issues that came with physical gold. Storage costs, purity concerns, and difficult liquidity when you try to sell it.
Exactly. The modern financial landscape gives us three major forms that mitigate all those traditional headaches. You have gold ETFs, exchange-traded funds, which offer amazing liquidity because they trade just like stocks on an exchange.
Easy to buy and sell.
Very easy. Then you have gold funds, which are basically mutual funds that invest in gold ETFs on your behalf, which is even simpler for some investors. And finally, you have the government-backed sovereign gold bonds, SGBs.
And these are special.
They are. They offer superior safety, a small interest payment on top of any price appreciation, and very favorable tax treatment if you hold them until maturity. For a long-term investor, SGBs are often the best way to hold gold.
Okay, let's touch on real estate, but through an accessible, highly liquid lens REITs. How are real estate investment trusts structured, and what type of properties do they primarily invest in?
So REITs are essentially investment vehicles. They pool funds from multiple investors to invest predominantly in income-generating physical commercial real estate.
Commercial, that's a key distinction.
It is. They're focused on office buildings, shopping malls, warehouses, and industrial parks, not typically residential units. They then distribute the income they get from rents and any property appreciation to the unit holders. It gives you exposure to the asset class without the massive capital commitment or the headaches of direct property management.
Finally, let's look at mutual funds, MFs, as a holistic structure. Whether they are debt or equity funds, how do MFs inherently support the idea of compounding for the learner?
MFs support compounding through the investor's choice of distribution. They allow investors to choose either the growth option or the dividend reinvestment option.
And both keep the money in the fund.
Exactly. By opting for either of these, any capital gains or dividends that are generated by the fund are automatically reinvested to purchase more units. This simple choice ensures that your returns compound exponentially over time, and it removes the temptation to withdraw and spend those periodic gains.
Right. We have spent decades accumulating a massive corpus using all the growth strategies we just discussed. Now we reach the retirement date. The music stops. The goal changes entirely.
Completely.
We are no longer chasing aggressive compounding. The priority shifts to generating a predictable, sustainable, low volatility income stream that has to last for the rest of our lives.
The shift in financial priority it's profound and it's irreversible. Products that are suitable for the distribution stage have to meet 3 criteria. First, they must primarily generate periodic income. Cash flow is king.
Absolutely.
Second, they have to maintain low volatility. A 20% drop in your principal when you're 30 is a buying opportunity. A 20% drop when you're 65 is a catastrophe.
It's terrifying.
And third, they have to provide adequate returns to keep pace with inflation while protecting that underlying principal. Growth becomes secondary to stability and dependable cash flow.
It's the transition from being a sprinter to a marathon runner.
A perfect analogy. And annuities are the classic marathon product. You trade a lump sum, your accumulated corpus, for guaranteed payments for life, which are provided by an insurance company. However, if that payment is fixed, it has one major existential flaw that every single retiree must face.
That flaw is the vulnerability to rising prices.
Precisely. That flaw is inflation risk. Fixed annuities suffer heavily from this because the value of the fixed income you receive will inevitably decline over time as the cost of living increases.
Right. $50,000 a month you get at age 60 buys a lot less by the time you're 85.
A lot less. That same RS, $50,000, might buy perhaps half of what it used to. This is the single biggest risk to a long fixed annuity payout. It's why just looking at the starting number is so misleading.
That's a powerful reason why retirement projections need to account for a high inflation rate. Now let's talk about taxation, which can be a stumbling block for new annuitants. How is that regular income stream treated by the tax authorities?
The income from annuities is not viewed as a capital return. It is taxable as income under the head salaries or income from other sources in the hands of the annuitant.
So it's treated just like a salary.
It is. It's treated just like regular earned income, and it's subject to your marginal tax rates, which is a major difference compared to the preferential treatment of long-term capital gains from equity.
Okay. Now, many annuities are sold with a return of purchase price feature. This guarantees that the original premium you paid is returned to your family upon your death. This sounds like an excellent security blanket for one's heirs, but it comes at a very definite cost to the periodic payout you receive today. Why is that?
It's purely a liability calculation for the insurer. When they offer that guarantee, the periodic payout is significantly lower, and it has to be. Because the insurance company assumes a higher risk and liability, they have to hold in provision for the guaranteed return of that principal, which means a smaller portion of your total corpus is available to generate your actual periodic income stream. You are effectively paying for that guaranteed legacy with a smaller monthly check throughout your retirement.
So it's a fundamental trade-off. Higher security for your legacy versus maximum income for yourself in the present. What other factors, besides these features, influence the annuity rate itself?
Annuity rates are profoundly influenced by factors that affect life expectancy. And this is where the pricing gets a bit counterintuitive for some people.
How so?
Well, older annuitants generally receive higher periodic payouts than younger ones.
Because they're expected to live for a shorter time.
Exactly. The expected payment period is shorter. Similarly, if the annuitant is assessed as having poorer health, the payout increases because, again, the insurance company expects to pay out for a shorter duration. They are essentially underwriting the longevity risk of the individual.
Leaving private annuities, let's explore some government-backed schemes that are designed explicitly for this income phase. The Senior Citizen Savings Scheme, or SCSS, is a hugely popular foundation for income generation for those 60 and over. Why is it so attractive?
SCSS is a cornerstone product for a reason. It offers guaranteed income and, critically, it usually features higher interest rates relative to comparable bank deposits and post office schemes. It acts as an income floor, ensuring an assured, predictable portion of your retirement cash flow, which is vital for covering those fixed monthly expenses.
Another key government scheme catering to this demographic is the Pradhan Mantri Vaya Vandana Yojana, or PMVVY. What's its mandate and who exactly does it serve?
The PMVVY is a scheme specifically designed to provide pension benefits for citizens aged 60 years and above. It really caters primarily to those who may not have robust formal pensions from the organized private sector. It provides an assured return for a fixed period.
And what are the defining constraints on that scheme in terms of time and the capital you can put in?
The maximum tenor for the scheme is 10 years. And to receive the maximum monthly pension, which is RFET 10,000, the maximum investment limit, or purchase price, is capped at 15 lakh rupees. So these limits clearly define the scale and the duration of the income assurance provided by the PMVVY.
Okay, so both SCSS and PMVVY, and even the Post Office Monthly Income Scheme, PBs, they all share a major hidden risk that retirees often overlook, and that's a reinvestment risk.
Yeah.
What is that and why is it so significant?
This is a major structural challenge with any fixed tenor periodic income product. Consider POMIS, which has a 5-year term, or SCSS, which has a 5-year term that's extendable to 10. Upon maturity, the principal is returned to you.
Right, you get your money back.
You get your money back, and the retiree is then forced to reinvest that large sum. Now, if interest rates have dropped significantly during that 5 or 10-year tenor, there is a real risk of having to reinvest the funds at a potentially much lower interest rate.
And your income just plummets.
Suddenly, your income shrinks. It exposes you to market risk at exactly the time in your life when you need stability the most.
So that stability is only guaranteed for the tenure of the product. Once it matures, the safety net disappears until a new rate is locked in. Just quickly, what is the current maximum investment limit for a singly held POMIS account?
The maximum investment limit for a singly held POMIS account is 4.5 lakh rupees. It's aimed at providing a modest but predictable regular monthly income.
Okay. If traditional debt products carry this reinvestment risk, how can retirees use mutual funds, which we normally associate with accumulation and volatility, to generate stable, predictable income during the distribution phase?
This is the true innovation of modern income planning. Mutual funds, even those holding volatile assets, can provide a predictable income certainty through something called a systematic withdrawal plan, or SWP.
The opposite of an SIP.
The exact opposite. Retirees set up the SWP to redeem a fixed, predetermined amount of units periodically. So you tell the fund, send me Rs 50,000 every month. Since you're redeeming units, rather than relying solely on variable dividends, it offers a predictable cash flow.
As long as the money doesn't run out.
Right. As long as you stick to a sensible withdrawal rate, like the widely discussed 4% rule, which is designed to help sustain the principal for longer.
When seeking higher interest income, investors often look past the low yield of GSECs. What's the fundamental trade-off that investors are making when they move into certain corporate bonds during the distribution phase?
They are consciously taking on incremental risk for increased yield. It's a very deliberate choice. Investors can achieve higher interest income by choosing to invest in lower credit-rated corporate bonds. They are explicitly trading off some safety-sum credit risk for a higher coupon rate or yield. This strategic risk is often necessary to try and generate sufficient income that stays ahead of inflation without depleting the principal too quickly.
Let's revisit real estate, but from the income perspective. Why is rental income considered such a natural hedge against inflation for retirees?
Rental income is naturally inflation protected because, generally speaking, the income goes up with inflation. As the cost of living rises across the economy, property values and prevailing rental rates usually follow suit.
So your rent checks get bigger over time.
Hopefully, yes. This ensures that the income stream from the property adjusts, remaining adequate to meet the rising expenses of the retiree. This passive income stream offers a robustness that fixed debt products simply cannot match.
We have to close this section with one of the most significant recent tax changes affecting fixed income planning. The tax treatment of capital gains from debt mutual funds has undergone a massive shift following the removal of the indexation benefit post-Budget 2025.
Huh.
What is the new rule that every debt fund investor absolutely must know?
This is a crucial change that really diminished the tax advantage that debt funds used to have. Capital gains from debt mutual funds are now taxed at the marginal rate of tax applicable to the investor.
Just like a fixed deposit.
Exactly. Previously, you had this benefit called indexation, which adjusted your cost of acquisition for inflation. This significantly reduced the taxable gain, especially over long holding periods. The removal of this benefit means debt fund gains are now treated similarly to interest income, making them much less tax efficient than equity or hybrid funds, especially for high-income investors.
We move now to a relatively modern and often necessary tool, particularly for seniors who are asset-rich but cash-poor. We're talking about the reverse mortgage. This is a targeted solution designed to address one of the biggest threats to retirement security, and that's longevity risk, or the risk of simply running out of cash before you die.
The reverse mortgage scheme, or RMS, is a mechanism that's designed to monetize your housing equity without forcing you, the homeowner, to sell or move out. The core mechanism is quite elegant, really.
How does it work?
A property that you own is pledged with a financial institution, a bank or a housing finance company. And against that pledge, a periodic income is paid to you, the property owner. The debt accumulates against the property's value, but the crucial cash flow, the income, flows to the retiree.
So it effectively turns a non-liquid asset, your family home, into a predictable income stream. What are the core eligibility requirements for the borrower and for the property itself?
The eligibility is quite strict. The borrower must be an Indian citizen of 60 years of age or more. And for the property, the key requirements are that it must have a clear title indicating the prospective borrower's absolute ownership.
No disputes.
No disputes. And it must be free from any encumbrances. That means no pre-existing mortgages, liens, or any other claims against it. The institution needs clean, indisputable collateral to issue the loan.
What is the maximum tenure available for a standard reverse mortgage loan, RML? And crucially, when does the loan actually become due and payable? This is often the most misunderstood part.
The maximum tenure specified for an RML is 20 years. But, and this is critical, the loan does not become due after 20 years if the borrower is still alive and living in the house.
Okay, that's important.
Very. It only becomes due and payable when the last surviving borrower dies or permanently moves out of the house. This protection ensures the retiree's occupation of their home until their death, irrespective of what the loan balance has grown to.
One of the reasons this scheme is so appealing is its incredible tax efficiency. Since the periodic payment is technically a reverse loan, how is it treated by the Income Tax Act?
This is the key benefit, and it's why it is so much better than simply selling the property and investing the proceeds. All the receipts you get as the homeowner under the RML are exempt from income tax under Section 1043 of the Income Tax Act of 1961.
So the monthly payment is tax-free.
Completely tax-free. Since the payment is legally treated as an advance against the future sale of the house, rather than as income earned, it avoids taxation entirely. This makes it highly effective for supplementing your retirement income without accidentally pushing you into a higher tax bracket.
Now, as you mentioned, the standard RML has a 20-year maximum payout period. If someone takes the loan at 60 and lives to be 95, they might run out of income at age 80. That's the longevity risk that's still there.
Correct.
And that's where the reverse mortgage loan enabled annuity, or RMLEA, comes in. What is the primary benefit of the RMLEA over a standard RML for managing this longevity risk?
The RMLEA is the structural evolution that's designed for true lifetime planning. Under an RMLEA, the loan proceeds from the bank are immediately used to purchase an immediate annuity from a life insurer.
So it's a two-step process.
It is. And this annuity, which is enabled by the loan, ensures a lifetime payout to the senior citizen. By shifting the income source from the bank loan to a life insurance product, the income assurance continues until death, regardless of how long they live. It completely addresses that critical longevity risk that the standard 20-year RML still carries.
We have successfully navigated a complex, but I think a vital landscape today.
Yeah.
We started by establishing that mandatory foundation of savings, the EPF structure, the power of those 12% contributions.
And that crucial new tax cap.
Right, and the crucial new R's 2.5 lakh tax cap that really acts as a financial signpost for high earners.
We then made that transition to voluntary accumulation, detailing the mechanics of efficient compound maximizing assets. We explored the superiority of guaranteed debt like PPF and NSC for long horizons, and the active strategy required for high-growth assets like equity.
Emphasizing that disciplined approach of SEPs to average out your cost over the periods of volatility.
Exactly.
And finally, we detailed that pivotal shift to the distribution stage, focusing on predictable cash flow products like SCSS and annuities, while also tackling the major structural threats like inflation risk and that reinvestment risk that's inherent in fixed tenor schemes.
And we broke down how unique tools like the tax-exempt reverse mortgage scheme are used to monetize illiquid assets and solve for that persistent threat of longevity.
So what's the big takeaway?
The core insight for the learner here is realizing the fundamental shift in financial engineering that's required for each phase. Accumulation demands products that prioritize compounding and limited withdrawals, things that almost force discipline upon you.
And distribution.
Distribution demands products that prioritize periodic, predictable income and low volatility. The specific tax treatment of these schemes, like the EPF limit or the RML income exemption, are the hidden rules that, once you understand them, provide genuinely actionable knowledge for optimizing your personal plan.
If we connect this back to the bigger picture, we can look beyond simply accumulating wealth for a distant retirement date. Our source material mentioned a key detail about another benefit, gratuity, which usually requires 5 years of continuous service to get.
Right.
But that 5-year service requirement is specifically waived for termination due to death or disablement.
That fact is incredibly telling, isn't it? It suggests that the financial structure of work isn't just about maximizing delayed gratification for some far-off retirement.
This raises an important question for you, the learner. How much of our early career planning should focus not just on long-term growth via high-risk accumulation tools, but on ensuring immediate financial security against unforeseen events like disability or early death?
A very important question.
Think about how the different instruments we discussed, the guaranteed income from the EPS, the insurance component of annuities, or this specific exception for gratuity, provide essential safety nets that go beyond just income replacement at age 60. They offer crucial, immediate protection for you and your family today. That active consideration of worst-case scenario protection is, I think, the ultimate test of a truly robust, holistic financial plan. Something to chew on as you review your next contribution statement.